It seems as though the president's heading into there, and he's expecting basically Europe to bend to his will.
So I think it's very dangerous to opine on what will happen given the volatility of the situation and given past precedent in terms of just last year. If you look at how tariffs turned out, there were so many twists and turns. So I think it's almost a fool's game to try to predict what will happen. We've done a couple of things which maybe can add some value. I was thinking about this before coming in. Number one, our European economists just did some sensitivity analysis that if 10% tariffs are imposed and come through as has been indicated, that could result in maybe 0.1 to 0.2% decline in European GDP if that works through for the entire year, and somewhat more of 25%
which
tariffs.
They could handle.
Yeah, which could be there. So just to put at least one number out there in the hope of adding some perspective. What I might say is, from a broader perspective, two added things, which is maybe broadening out from, say, Greenland specifically to the larger issue of geopolitical risk. Because obviously geopolitics, just with the 2026 having just being a few weeks old, already we've seen Venezuela, Greenland, and some other areas. So I think we can say two things. One is that markets, having had a very good 2025 and having, particularly the Asian markets, which I'm responsible for, having run up very strongly, 27% for the MXAPJ index, and having gone over 9 months without a meaningful pullback, that the historical clock is ticking in terms of markets being overdue some sort of a correction. If you go back over 15, 25, 35 years, on average you get a correction once every 8 to 9 months, 10% correction or more, and we've not had that.
We're overdue.
And valuations, of course, are high, and we started this year off on a good note. So if there's a catalyst in the form of geopolitical risk concerns, then I think investors need to be aware that there could be some sort of a pullback. Indeed, we just had a series of investor conferences in Europe last week, which I was attending in 4 different places, over 1,000 people in different locations. And when we polled the audience, the largest risk element among a variety of different questions was geopolitics. Like over 40% of the audience raised their hands or voted electronically to say that geopolitics was the biggest risk.
Let me interject here. But why now? Because we're 4 years long into this Russian invasion and ongoing war in Ukraine. Right, oil's at 63-ish, right? Yields are where they are. It seems as though markets have ignored all of the geopolitics.
True. So that's right. And I think the reason, in part, Martin, is that the relationship between geopolitical risk and markets is not linear. The metaphor that I find helpful to describe this is like those high school chemistry experiments when you are dropping some liquid into a beaker and you keep dropping, nothing happens, and then with one final drop, the color changes, right? So you hit this sort of state change where nothing matters until it does. And I think that's an apt metaphor for geopolitical risk because markets tend to ignore it until it really matters. And then when it matters is oftentimes a function of the psychology of the moment as well as obviously the fact pattern. So really the point I'm trying to make, two if I could. One is that markets are overdue some sort of a correction, and the current elevation in geopolitical tension could be a catalyst to have some correction taking place. If that's the case, there are modalities that we're suggesting to help mitigate that. There's either some derivative strategies or some so-called 1 delta, just lower beta, higher Sharpe ratio trades that we think make sense to balance out a portfolio.
Okay, you're an equities guy, right? When you take a broader look, though, folks take a look at your classic 60-40 portfolio, 40 being bonds, of course, and they're looking, bonds, I don't know if they are really going to do it for me, Maybe what folks should be looking at would be in the equity sleeve, right, of any portfolio, energy names, even if they're ETFs, right? Because they're throwing off good yield, and in this kind of environment could provide the kind of protection that bonds are not right now.
Well, I have actually a lot of sympathy for what you just said, for 2 reasons. A, that if you look at valuation of long-dated fixed income, it's okay, but not great in terms of the amount of term premium that one's getting, and given the longer-term dynamics and concerns. just for example, in the U.S. bond market, about 6% of GDP, fiscal deficits for the foreseeable future, et cetera. So you might not get as much protection as you indicated from that sleeve of the portfolio. On the energy side, I have some sympathy with that. We're actually underweight energy right now and have been last year. But one of the points we made in our 2026 Outlook piece we published just about 10 days ago was that as we go through 2026, we might want to start thinking about taking a more constructive view on energy for the reasons you mentioned. One, that you get a good dividend yield, you're paid to wait. Two, the valuations are low relative to historical ranges and also the amount of the implied energy price that's discounted into share prices. And three, even though we expect energy prices to be lower this year, we think demand-supply balance will tighten as we get into 2027, the latter half of it, and equity markets being forward-looking entities may start to anticipate that in the latter half of this year. So our view is that maybe a little bit early to pull the trigger on energy, but we're certainly warming up to it.